Welcome, everyone. This is a webinar organized by the Wharton Initiative on Financial Policy and Regulation, in short, WIFPR. I'm Itay Goldstein here at the University of Pennsylvania, the Wharton School. I'm the director of the initiative. At the initiative, we are trying to bring policy topics on the top of the agenda, issues related to financial regulation, and have a live debate and discussion on them. As part of this process, we are commissioning white papers on important topics. And a few months ago, we commissioned the white paper from Chester Spatt and Thomas Ernst to talk about pay for order flow. All of us have heard about pay for order flows. It's been all over the news since 2021. With the episode of meme stocks and gamification of the trading process, and pay for order flows was at the center of attention, getting much of the blame for some of the chaos that we saw in financial markets. The SEC was quick to respond with a few policy proposals, but there is a lot to debate and a lot to discuss, and some of these things are quite controversial still. We looked for people to write on this topic, and we could not have found a better match than Tom and Chester. Chester obviously needs no introduction. He is the Pamela and Kenneth Dunn Professor of Finance at Carnegie Mellon University and has been there for over 40 years, I believe. And he's been in other places over time in various visiting positions and professional functions. Most notably, I think in the context of the current webinar is that he was the chief economist at the SEC between 2004 and 2007. Tom is a newly minted PhD from MIT, who is now in University of Maryland and has been there for a couple of years as an assistant professor. And the two of them joined forces and wrote a bunch of academic papers on pay for order flows and other related topics in market microstructure. They have quite an impressive output on these issues. The way that we're going to organize the webinar, we're going to start with Tom and Chester giving us a short presentation of their paper. I should say we follow the process by which we had a roundtable with participants in person back in May. They got a lot of comments from experts in the field, legal scholars, finance scholars, policymakers, as well as practitioners. They took all these comments and worked on the paper, revised the paper, and produced a final version of the white paper that is now available on our website at WIFPR. We conclude this process with this webinar where they will present their findings and answer some questions. So we will start by having them present for about 15 or 20 minutes or so. And then after that, I will ask them some questions. Everyone else in attendance, feel free to ask questions as well. All you need to do is use the Q&A function on your screen. So we will watch these questions and integrate them in our discussion. So please feel free to do that. So with this, let's get started. Please share your screen and have a short presentation of your.
Thank you. Thank you very much, Itay. So I want to start with this graph. So payment for order flow has been around for a while. With the surge of retail interest, there's been a surge of interest and attention on where brokers are making their money. And a lot of the conversation around PFOF has been about the equity market. And what got Chester and I really interested in this market is if you look at the actual payments, here this graph is the total monthly PFOF that brokers are bringing in each month. Over 2/3 of all the payments are actually in the option market. And so what we're going to look at in this paper is, why is the market structured like this? And we're going to show that there are some problems in the option markets. We think there are some specific entry barriers that limit competition. And the other problem is that the fact that options pay so much more in PFOF than equities gives brokers some very perverse incentives. So what we do in this paper is we then, after highlighting these problems, we come up with some regulatory proposals. So first, the SEC has been focused exclusively on equity markets and hasn't come up with any proposals on the option markets. So we look at those and we think that the SEC could actually do some more modest enhancements to equity markets that kind of build on what's there rather than creating something new. But we also suggest a couple of methods that could increase competition in option markets. And finally, we suggest a simple cap on PFOF rates, a simple fee cap that the SEC could impose. So what I'm going to do in this talk is I'm going to first give a little bit of definition and background. What is PFOF? What is price improvement? And how do brokers set up competition for retail trades? Then I'll talk about some of the concerns around PFOF, and then I'll turn it over to Chester, who will present some of our solutions for regulating PFOF. So it's going to be all pictures here. This is what order routing looks like when a retail broker wants to route an order. We start with a customer on the left. They place an order through a retail broker. I have Schwab, but the process is the same for Fidelity, Vanguard, E-Trade, all the other major brokers. The broker's duty is to get the best price possible for their client. They could do that by going to an exchange like NYSE or NASDAQ, but instead they could go to an off-exchange market maker, a place like Citadel or Virtu. Now, there's a lot of competition for retail trades. They're often thought of as being more desirable than anonymous market order flow. If you think about a Gloston-Milgram model, a market maker has to worry about who they're trading with. If you trade against a hedge fund, you might actually regret that trade. So when we think about retail traders, we know they're not professional traders, so they might have lower adverse selection. They also tend to be small. When they place an order, it's a one-off order. It's not the first of a very, very large parent order. And for both of these reasons, market makers would much rather trade with a retail trader than just a general anonymous order. So there's going to be two ways that market makers will try hard to get retail trades. The first way is through offering price improvement. So if you think about NASDAQ or NYSE, these are exchanges. So their quote under Reg NMS has to be publicly available to anyone who wants to trade at that price. And it's an anonymous market. You don't know who's coming in. If firms like Citadel or Virtu can get orders directly from Schwab, they know they're getting a retail order, and they're able to offer better prices than publicly quoted spreads. We're going to call this price improvement. And what's important about price improvement is it goes to the customer. The customer is getting a better price than they would have gotten trading somewhere else. So then the other key definition is, of course, PFOF, payment for order flow. Now, PFOF is different in that it's a payment from the market center to the broker. So in this case, Citadel or Virtu would pay Schwab directly for every order that they get. So this is a benefit to the broker, not the benefit to the customer. Now, PFOF, of course, creates an inherent conflict of interest. Do you route for the customer, or do you route for the PFOF? So what brokers have done to mitigate this is they'll set a uniform PFOF rate across all wholesalers. So Schwab, if they're charging Citadel 1 cent for every order they send, they'll charge Virtu, Jane Street, and 2 Sigma. Those are all different wholesalers. They'll all charge the same rate. And then the way competition actually works in this market is it is based on aggregate prices. So in every individual order, you're not going to call up every single wholesaler. You don't have time. You send the order to one wholesaler and they have to immediately fill it. But what brokers do is they monitor past performance. So every month, they'll look at all the wholesalers on average. They'll look at how they did on trades. And the wholesalers who gave the best prices will get more orders in the future month. The wholesalers who gave inferior prices will get less orders in the future month. So every single month, brokers are going to score wholesalers and they're going to route to encourage competition. So what I want to do now is take a bit of time to talk about some of the concerns about this market. The first concern is a narrow one. Could customers obtain better prices on each trade? Second one is a broader concern about market quality. Is the system brokers setting up really all that competitive? And then the third concern is, well, what does this actually do to broker incentives when we give them PFOF? So to the first point, there is an inherent trade-off between PFOF and price improvement. And that if you think about Citadel wanting retail orders, they want to compete against an exchange and to get retail orders. Whatever dollars they're willing to commit to PFOF go to the broker. Those dollars are not able to go to the customer in the form of price improvement. So there is this direct trade-off here. But one thing I want to highlight about this trade-off is it's important to keep it in terms of a broader perspective. which is that if we think of PFOF as an implicit commission, then commission rates have dramatically fallen. If you go back to like a $5 commission, for a 100-share order, a broker today would earn 20 cents in PFOF. Now, of course, it's a bigger order, they'll earn a little bit more in PFOF, but still from $5 to 20 cents or maybe even 40 cents, there's a huge commission cut going from fixed commissions to PFOF. The second concern I want to highlight is whether this market itself as a whole is competitive. If you think about a broker, they're doing the best they can. They're ranking these wholesalers based on how they do. But we have to think, are these wholesalers all equal? Who's in this wholesaler market? And the problem here is that wholesalers actually face very large fixed costs and economies of scale. When you're a wholesaler, you're committing to make markets in thousands of securities. You're buying all the exchange data feeds, which is a high price. And there are also certain economies of scale, like the more you trade, the cheaper the pricing you get from exchanges if you do trade on exchange. So there are some problems in this market. And where Chester and I think they are particularly bad is in the option market. So in the option market, all trading has to occur on exchange, but exchanges have ways of making it easy to internalize. Internalizing is the idea that if you buy order flow from a broker, you want to make sure you're the one who trades against those orders. And one really critical way, the most technical point I want to make, is that in the option market, this often happens through designated market maker assignments, where exchanges will appoint one DMM per symbol, and that DMM has some quoting obligations. They get a trading fee discount, but also they get the ability to route orders to their own quote. And this is really important for internalizing. And the problem with that is these DMM assignments are not assigned equally. If you look at which firms hold these DMM assignments, it's a very unequal distribution. Citadel holds around 30% of the seats. Susquehanna holds around 30% of seats. If you look at a firm like IMC, they own 2% of these seats. It's a very unequal distribution. And if you look at who dominates the retail wholesaling business, it's the same firms that dominate these DMM seats. And so this creates a problem where there's a very unequal playing field here. If you think about, let's say Schwab is going to rank some wholesalers based on how they do on the order flow they're sent. When Citadel gets that order flow, they can always use a DMM seat to internalize trades. If a firm like Dash is trying to compete for that order flow, they're almost never going to have a DMM seat available. And that makes it harder for Dash to internalize those retail trades. So this is a system where you have kind of a very high entry bar to becoming a wholesaler. And that can lead to imperfect competition among these different wholesalers that could protect high wholesaler revenues and lead to high PFOF. And that high PFOF is what leads to our third concern, which is what kind of incentive structure does it give brokers? If you look at just the raw payment rate, for every 100 shares that a broker routes, they get paid twice as much when it's an option order compared to when it's an equity order. That actually understates the true difference. The reason is, if you think about, let's say, investing $1,000, if you invest that in a $100 stock, that generates just 10 shares of trading volume, which would give you 2 cents of PFOF. Options tend to be much cheaper than stocks. So if you invest $1,000 in options, let's say a $10 option, that generates a full 100-share order, which is 40 cents of PFOF. Now, back in the $5 commission era, $5.02 versus $5.40 is perhaps not such a big difference. But now that we're in this zero commission era, the broker is looking at a revenue of either 2 cents versus 40 cents. And that is a tremendous difference in revenue. So brokers have always benefited when clients trade. This era of $0 commissions has ushered in a new substantial discrepancy across assets in terms of how much revenue brokers bring in. So with that, let me turn it over to Chester, who's going to talk about some of our solutions.
Thanks, Tom. So we have in mind several ways to perhaps modify the existing market structure. Some changes to the equity market structure, changes which actually may be somewhat less intrusive than the changes proposed last year by the SEC. Changes to the options market structure, which the SEC's proposal last year did not address, and the possibility of a cap on the payment for order flow rates, and how that ties in to the different to both the equity and option markets. So the SEC's, the heart of the SEC's current proposal, which is proved to be quite controversial, is a new Rule 615 that would mandate order-by-order auctions for retail trades where the retail trades are not being where the retail trades do not otherwise have the opportunity to be executed at the mid-quote. So these order-by-order auctions would lead to a substantial overhaul of the current market structure. And I think our thinking is that the current market structure in the equity markets is actually quite competitive because the brokers hold the feet to the fire to the wholesalers based upon their past performance. And in a model with Yan Sung, we analyze order by order auctions and basically show that those auctions would suffer from a winner's curse. And basically what our paper shows is that the market makers, because they would be in different circumstances on individual orders, particularly orders for small and illiquid stocks, that there would be a winner's curse that would get in the way of competition, because the brokers would be in very different situations ex post. There would not be as much competition. I think the SEC's thinking is that ex post competition, because it occurs later, is better. Our model suggests that in fact ex ante competition is potentially better. And also the SEC's proposal would not guarantee that the auctions would be successful. And in fact, empirical results by Battaglio and Jennings suggest that the auctions might fail. So what we propose to deal with some of the issues in the equity markets is sort of much simpler, and I think much less intrusive to the current design. So currently, 5 exchanges offer retail liquidity programs whose goal is similar to the SEC's proposal with auctions, in particular, providing that retail orders would be segmented in competitive limit order books. But in particular, while the current retail liquidity programs have not been all that successful, I think we've identified a couple of reasons why we think that's the case, or why it may be the case, and we think that the SEC ought to be sort of pushing on. The first is that the prices offered by most of these programs are not displayed, and that the exchanges should display the pricing for the retail liquidity programs. Currently, only the IEX program displays the pricing. And furthermore, quotes being offered through these retail liquidity programs do not get the benefit of the order protection under the SEC's NMS framework. And we think these enhancements would have at least a potential to increase the impact of the retail liquidity programs and perhaps improve modestly equity market performance without overhauling the whole system. Now, turning to the options markets, the typical option market access fees are actually much higher than equity market access fees, 50 cents a 100 versus 30 cents a 100 in the equity case. And the SEC has proposed cutting the equity access fees, but has ignored the option market access fees. I think our thinking is that perhaps the option market access fees ought to be reduced as perhaps part of this. Furthermore, one aspect which is striking in the options markets are the role and importance of the designated market makers. But at the same time, these designated market makers are rarely reassigned, and we question whether that's optimal. Basically, once one obtains a designated market maker assignment, those assignments are basically locked in and without limiting greatly the competition. And as Tom highlighted, there's a very skewed distribution of these assignments, and furthermore, basically this constitutes a huge entry barrier. Indeed, we found in a companion paper that the designated market makers who pay payment for order flow quote much wider spreads than those who don't pay for order flow. And we also found that the ability of the designated market makers to self-route to basically route to themselves limits their incentives to compete against the rest of the order book. So finally, with respect to the payment for order flow, we're suggesting that the SEC consider the possibility of capping these fees, similar to the current cap on trading access fee for exchanges. By definition, of course, a cap binds in the trades with the highest payment for order flow. One advantage of a couple of advantages of a cap. So first, it would put on a more equal playing field the issue of payment for order flow between the equity markets on the one hand and the option markets on the other. Furthermore, a cap provides, I think, an interesting mechanism which in the past the SEC has not exploited. Namely, if you impose a cap, it provides a lever where you can potentially then over time tighten the cap, but perhaps tighten it sort of modestly, and in that way make gradual adjustments to the marketplace. So in conclusion, the SEC in conclusion, payment for order flow has allowed zero commission trading, which has been, I think, potentially hugely beneficial to the market. At the same time, over 2/3 of all the payments are in the options markets. Meanwhile, limiting competition in option wholesaling, and with brokers being paid substantially more when their clients trade options rather than trading equity. And so with these issues in mind, we're proposing several solutions. We're proposing in part expanding and enhancing the retail liquidity programs by basically building on existing programs, but to try to achieve similar goals to order-by-order auctions. Changes in the structure of the options markets to either reduce self-routing and cutting access fees, and leading to more entry into the role of designated market makers, and finally the possibility of introducing a fee cap on payment for order flow. It already applies to access fees, and this could potentially provide a lever to undertake modest and gradual reforms of the payment for order flow in a way that would be kind of gradual rather than disruptive to our marketplace. And so now we look forward to Itay and your questions.
Okay, thank you very much, Tom and Chester, for a very clear presentation. Very interesting paper explaining the problem and also providing solutions, policy solutions going forward. I want to remind people in the audience, if you want to ask questions, please use the Q&A function, and I will integrate some of the questions that we get from the audience with some of my own questions. Let me start with something general. So one of the main takeaways from your paper is that the problem arises much more strongly with option markets than with equity markets. And my question is, if you could really highlight what you think is the key difference between option markets and equity markets that generates this, And to what extent was this surprising to you? I mean, both of you know these markets pretty well. Did you expect this going into this project, or is this something that you kind of stumbled upon and found out more about in the course of your study?
Oh, Tom, you're muted.
All right. So let me start with one obvious thing we can start with is that the quoted spreads and options are a lot larger, right? So just, in terms of how much money is potentially on the table for either price improvement or PFOF, there's a lot more potential money on the table because the quoted spreads are wide. In equities, if there's a 1 penny bid-ask spread, PFOF's got to be smaller than that. But of course, at the end of the day, quoted spreads could be wide for a lot of reasons. So I think the other thing that we didn't realize is just how difficult and convoluted the process of internalization is when it comes to options. In equities, if you want to internalize a trade, you just directly trade against the customer. In options, you have to have, there's a set of ways to do it, and DMM seats are probably the biggest, one of the best routes to internalize a trade. And I think that's what we really learned through this process is because there is this entry barrier to becoming a DMM, that creates a big entry barrier to becoming an option retail wholesaler.
So just to follow up on that, so while I think many observers think that internalization is too easy in equity, what we observed is that there's at least free entry and competition with respect to internalization in equity. Whereas in the options markets, there's a much more awkward type of structure, and not anything near free entry. The one other point to note, and I think something we did expect, of course, is that the options markets are highly diffused across many instruments, many series, and also a lot of those series, especially when they're out of the money, lead to a lot of scope for adverse selection. So to some extent, the spreads are naturally a lot higher. And this is, I think, one of the challenges that regulators do face. But I do think at the same time, consistent with the types of proposals that we've advanced today.
Yeah, very good. One related question from the audience, and I will read it here from the Q&A. PFOF in options is higher, not just because the same amount of dollars buys more options. PFOF in options is much higher because spreads in options can easily be 30 to 35 cents against 1 or 2 cents in the underlying stocks. The adverse selection component that generates the ability to offer PFOF is as a result much greater per share. Is that not a more relevant argument?
So from the wholesaler's perspective, I think that absolutely matters, right? If you think about the difference in adverse selection between a retail trader and a non-retail trader, or just how much spread they're willing to make on that trade, that's what determines what they're willing to pay. But then I think from the broker's perspective, the dollar invested is really what matters, because the broker, they're not getting the spread. They don't care about the spread. What they care about is maybe the price improvement or the PFOF that they're getting, either the price improvement they're getting for their customer or the PFOF that they're getting for themselves. And what we want to highlight is if a broker is trying to maximize PFOF, having their clients trade these assets with really wide spreads is what will maximize their PFOF revenue.
Yeah. So moving forward, kind of following up on this line of discussion, I asked you if you were surprised by what you found about the option market relative to the equity market. When you look at it, are you surprised that the SEC was not more aware of it and perhaps should have emphasized the option market more?
Yeah. I think we were. I think we were surprised. Now, the option market issues are potentially more complicated. But we were surprised, I think, in part because I think most observers think that the equity markets are functioning very well. And I think at times the commission has been perhaps misled or confused a bit by the use of phrases such as trading in the dark. So a lot of criticism that in the equity markets, there's a lot of off-exchange or dark type of trading. But in fact, these markets all have price report. They all have post-trade price reporting. That's near instantaneous. The price reporting is happening within the price reporting is happening in milliseconds. So and I think in that sense we're kind of surprised. I think some of it is not really reflecting on the meaning of internalization and how internalization is working across the markets.
Okay, excellent. So again, thinking about a general point that I think comes out of your paper and also some of your academic papers in the topic. Typically, when we have these kinds of frictions, one of the things we often go to is just increased competition. And we tend to say, more competition is going to solve the problem. In some sense, there are proposals out there to increase competition, but what you're pointing out, there is then sort of the unintended consequence of winner's curse that might potentially make things worse. And I think you point that out very clearly, and you have a companion paper that makes that point empirically. But then you do go back to some of the other proposals that are, at the end of the day, about increasing competition. So where is exactly the line in your mind? I mean, how do we know when competition is going to be effective and when it is going to backfire and generate this winner's curse?
Well, I sort of one observation I would sort of start with is that I think one of the things that our related studies sort of have highlighted to us is that potentially ex-ante competition may be more desirable than ex-post competition. That ex-post competition is maybe more limited because of the heterogeneous situation of the participants on the other side, and ex-ante competition kind of avoids that. One of the lessons I think that we I think we've understood for a long time from economic theory is that just adding an extra stage to a mechanism doesn't necessarily make a mechanism more competitive, and in fact, potentially it changes the incentives at the earlier stage.
I think maybe also say this is a question that is a very deep question within economics with a long history. So one of the things that people often say is they say the wholesaling industry is very concentrated. There's two firms that have a very large market share. But then we can think back to early economic work. If you have Bertrand competition versus Cournot competition, there's a tremendous difference in how competitive the system can be with just two players. And so I think that's kind of what you see here in the equity space. In the equity space, it's very concentrated. There's only a few players, but that I think is mostly due to economies of scale. I think there is fierce competition. In the option market, we really do think there are some specific barriers to entry that should be lifted. Yeah.
Okay. Thinking about some of the policy proposals, one question that comes up from the audience is, what are your thoughts on allowing midpoint orders in option markets?
I think, I think maybe what I would say is, you could, in a sense, trade at the mid quote by placing a limit order at the mid quote. Maybe one way this could be implemented is hidden orders in the option market. I don't know if I have a particularly informed opinion about that. But maybe the other thing I would say is a different way to think about the problem in option markets is that when the quoted spreads are very wide, there might be more of a dynamic choice between when you should use a market order and when you should use a limit order. And I think that's a choice that most retail traders are not going to be particularly well informed about making. And that's maybe partly why we want to have a lot of protections for market orders up here. So if you think that retail traders are just going to hit the buy button, if the quoted spreads are very wide, we have to really make sure that they're getting as much price improvement as they possibly can.
Right. Now, thinking more about some of the barriers to competition, there is another interesting question here from the audience saying that you highlight one particular aspect, which is the ability of DMMs to execute retail orders. But there are also other potential barriers like fixed costs, high return to scale, big disparity in the breakup fees in price improvement auctions between an affiliated market maker and competitors, and even marketing fees that are not transparent. So the question is, which one should we really focus on? And does it matter really which one we focus on when we think about the solutions?
Yeah, that's a really great question. So I'll highlight, Svetlana has a very nice paper that looks at how retail trades often end up in auctions. And that's something we didn't talk about in the presentation for time, but we do address a little bit in the paper. And there are some limits to competition in these auctions, in the options space. And there, I think there's kind of two routes that regulators could take. One route is if you reduce the entry barrier to becoming a DMM, if more firms become DMMs, then you can get really good competition at the broker wholesaler level. So all wholesalers will be on equal footing. They can compete to get order flow directly from the broker. We think that kind of solves the downstream problem of what happens in these auctions, as long as you have competition at that first level between the broker and the wholesaler. Now, if you don't want to open up DMM positions, a second way to try and address competition would be to go to these auctions and try and address competition there. We talk a little bit in the paper about some of the things this question mentioned, right? With breakup fees, making those auctions more equal so that everyone who bids in the auction has an equal footing. But I think there's kind of two levels of competition here in this market. The first is getting the order from the broker. The second is if it goes into an auction, can everyone bid in the auction fairly? The SEC could fix both of these, but I think it would also be a big improvement if they could just fix competition in one market or the other.
Okay. And I should mention, yeah, go ahead.
I was just going to say one thing I think there hasn't been enough attention focused on are the rules associated with auctions. It's not simply whether you have auctions or not, but what are the advantages that flow to different parties with respect to things like size of allocation and the like, or who initiates the auction and whether they get some advantage. But there's a bit of a tension between that and incenting the parties to actually want to go ahead and use auctions. And indeed, I think one of the criticisms as well of the SEC's proposal for equity auctions is a lot of the details of the auction design are not very well spelled out.
Okay, excellent. Now, some of your policy proposals might carry some unintended consequences of their own, and I think that you are very well aware of it. And one in particular, I think that raises some eyebrows is the PFOF cap. And I think there are all sorts of issues that come up with caps that are sort of artificially imposed, and you don't know exactly what is the optimal cap and how to calibrate it, how to adjust it over time, and so on. So if you thought more about that, how would it work? Will there be differences between the equities and options on the caps, and how would you really determine what it should be?
Well, I think here I think we've taken a relatively soft view. I think that's why we're sort of envisioning that the initial caps would be relatively wide, but with the notion of then trying to tighten them over time. To some extent, this is a little bit what the SEC started to do under Regulation NMS. They imposed an access fee cap of 30 mils, in part because that was what was prevailing at the time. But the difficulty is, so that was adopted in 2005 and fully implemented in 2007, and until the current proposal, basically the current proposal by the SEC. They haven't really gone beyond that. So I think we're certainly sensitive to the complications and harm that might result from price caps, and I think that's why we're proposing it in the form that we did. But with the notion of being more serious about gradually adjusting.
Okay, very good. Going back to where I started this webinar, and this is something a lot of people will have in mind now, especially given that the movie Dumb Money is now out. describing the events of early 2021 with GameStop and other meme stocks. And this is really what generated all the anger on this phenomenon, starting from gamification, Robinhood, all sorts of things like that. But payment for order flows has been mentioned as one of the things that should be targeted. So now that you look back at all this with the work that you've done, do you think this is justified, all this anger? Do you think payment for order flows is indeed to blame for some of these things?
Well, I think one, in my mind, the payment for order flow is perhaps a bit off the track. I thought a lot of the anger came about because of the necessity by Robinhood to close down various trading activity, and I think a lot of that was related to kind of the nature of the margin calls that they were getting, which were frankly puzzling to many retail investors, because Robinhood was requiring people to pay in advance. So it wasn't, so I think there's a lot of lack of transparency about the margin calls on the firms and what the firms needed and what a firm like Robinhood needed to do in response. And I would have thought that would have been a more well-placed direction for the regulators to pursue.
Yeah, I think the anger, probably came in two stages. One for the events to begin with, and then for the reaction. But yeah, certainly point well taken. You've done, we are very close to concluding here. I'll say you've done a lot of work, not just for this white paper, but for the academic papers that you have as companions to that. And you collected a lot of data. And what I hear talking to you now is that you discovered more data and you're going to do more work. So there is clearly a lot to look forward to. If you had to highlight one thing that we still need to know, maybe blind spots, things that should become more transparent, what would it be? What would you ask for?
So I actually think a lot of what's going on around these DMMs is happening in the dark in the option market. So I think these exchanges are giving out potentially very large benefits to some market makers. And I think, we don't say that we should stop having DMMs in the paper, because we just don't know. There may be big benefits to having DMMs. And I think that's something where there could be a lot more transparency in terms of what is the role of these very large market makers.
And one related problem is that even the type of data that we have, it's a little bit limited. We basically have price data, and we know who the DMMs are for the different securities, but we don't have data on which brokers were handled which trades, and which trades were then routed through the DMMs, which trades were routed through other market makers. We draw some inferences about that, but the standard data sets don't really speak to that. And I think one other point that I would flag, which is not as directly related to our research agenda, is this issue that I was raising about collateral requirements on the firms, as illustrated by the GameStop situation. I think there's not the type of transparency there that would be very helpful for everybody to understand. And I think that as was mentioned before, caused so much turbulence in January of 2021.
I think maybe the broader point here is data is critical for academic work. You really need data and transparency to be able to analyze markets and figure out what's going on.
Okay, Thank you very much. So we are out of time. Thank you, both of you, for excellent presentation, excellent work. The paper and the webinar are going to be available on WIFPR's website. And stay tuned to our next events. We're going to have another webinar next week on payment systems. So look forward to seeing you in the future. Thank you also to all the people in the audience and for the excellent questions. We were not able to get to all of them, but you can follow up with us and with the authors. Thank you.